Dr. Gilad Isaacs, the Executive Director at the Institute for Economic Justice. Gilad, sorry we had lost you there, and of course the audio wasn't connecting with us, but I believe we have you now. The question I'd put to you was around inflation targeting. The official position of government is now a 3% inflation target with a standard deviation of 1% from that point. But more importantly, we're always told that this is necessary so that we can use monetary policy tools to protect price stability and currency erosion. That this best protects the middle class, the working class, and particularly the poor, because it means that they're not dealing with runaway costs and escalations. Although cost of living still pinches all of us in incredibly insidious ways. What is your position on that announcement today by the Minister? My goodness, seems like we once again don't have Gilad Isaacs. Gilad, can we try that again? There we go, there we go. We've got you now. There we go.
Are you able to hear me?
Loud and clear, go for it.
Fantastic, thanks very much for having me. I think it's important to note that inflation can have a negative consequence on the particularly unexpected inflation and inflation where our incomes don't rise in tandem with that inflation can have a negative consequence on working people in South Africa. What I think is very important to bear in mind is with what tools we are proposing to try and address that inflation. And it's really on this level that the Reserve Bank's prevailing approach raises serious concern. And the approach which we adopt in South Africa for reducing inflation and hitting that target is the manipulation and of the short-term interest rate. So we use interest rates and particularly increases in interest rates to try and limit inflation. And the way that works is increasing the interest rate makes lending and borrowing in our economy more expensive, and so we see less investment, less economic activity, and so there's less demand for products. And those products' prices fall. That's the overt logic of the Reserve Bank inflation targeting approach. Essentially, try and strangle aspects of the economy to limit inflation. Unfortunately, what we have is that the medicine is often worse than the illness in this instance. And what it leads to is excessively high real interest rates, which makes borrowing for both households and the governments more expensive, and is actually ineffective at addressing the sources of where inflation is actually coming from. Because inflation in South Africa isn't driven by a buildup of excess demand in our economy. It's often imported. It's through fuel prices. It's through administered prices like electricity, and so it's a very, very blunt instrument, inflation targeting. So absolutely, there is nothing wrong with aiming for a 3% inflation target, but we really shouldn't be doing that with the tools which we're using currently.
Yeah, just a last question, and this is on a more esoteric problem in South Africa, and that is our runaway debt crisis. We've seen a commodities rally over the last couple of months, particularly with gold, which means that South Africa is collecting a little bit better than expected in that sector of the economy. Should we be using that to service our debt? Because we do have a runaway debt crisis, but more specifically, we're being told that South Africa's debt is being used to fund an expanding social services program. which includes things like, and hopefully it will be converted to a universal basic income grant, but South Africa's relief of distress grant, which is seemingly here to stay, and other related social welfare policy. What's your view on how to deal with excess, should we ever have it, in instances where we have a quarterly surplus or whatever the case may be, in dealing with our debt crisis in relation to social services?
Yeah, no, it's an important question. I would not frame South Africa as having a debt crisis. South Africa's borrowing is at a similar level, at about 78, 79% of GDP. That's just marginally above the average for emerging markets. So South Africa has fairly normal and prosaic levels of debt. The issue which we face is actually that we pay a significant premium on that debt. So we pay almost double the emerging market average interest rate. So it's not so much that we're faced with a particular quantum in which South Africa is completely average. It's more that we are being charged very high interest rates. And for a long time, we've called on government to proactively intervene through the Reserve Bank, through interventions like prescribed assets, in order to ensure that we're able to borrow at a more affordable rate. I would like to, absolutely there are limits to the extent to which we can borrow, but what we have to understand is that the fiscal consolidation which we've witnessed so far has essentially occurred on the back of ordinary South Africans. We have reduced borrowing by not filling vacancies in our hospitals, in our police force. We've reduced borrowing by not investing in our schools. We've reduced borrowing by limited inflationary increases on certain social grants, and those have very real social costs also.
Yeah, we're going to have to leave it there. Gilad Isaacs, thank you so much for your time. Really do appreciate it. Dr. Gilad Isaacs is the Executive Director for the Institute of Economic Justice.